Hey everyone, welcome to today's Explainer. Today, we're tearing down a massive, incredibly detailed equity research note on Polycab India. We really want to figure out, is its absolutely incredible market run truly backed by solid business fundamentals, or is it just coasting on pure momentum? We're going to unpack over 150 data points from this forensic analysis to give you a really clear, structured look at this market leader. So, let's get right into it.
Let's kick things off with a number that is just mind-blowing, 800%. Seriously, since its IPO back in 2019, this stock has delivered roughly an 800% return. It has absolutely crushed the broader market and multiplied wealth for its early investors. We're talking about a true compounder that has barely stopped to take a breath over the last 5 years.
But that brings us to the massive elephant in the room and really the core tension of this entire explainer. Does a traditional manufacturing business, a company that primarily makes wires and cables, really justify a premium valuation multiple of 47 times its trailing earnings? Is the market correctly pricing in years of future dominance? Or is this stock priced for absolute perfection with literally zero margin for error?
Part 1. The Undisputed Cable King. So Polycab isn't just your run-of-the-mill generic electricals brand. They are an absolute juggernaut in wires and cables. Over 87% of their record 28,884 crore rupee revenue comes straight from that core segment. Now, they are actively pushing into consumer electricals, fast-moving electrical goods, which makes up about 7.2% of revenue, and they do have an engineering, procurement, and construction segment at 5.8%. But make no mistake, that massive cable business is the cash-generating engine powering the whole shebang.
And the economic moat they've built around that engine? It's basically a fortress. They command a 30 to 31% share of the organized domestic market. How did they do that? Through a sprawling distribution network of over 4,000 authorized dealers spreading across more than 2,800 towns, all backed up by 27 manufacturing plants. That is a kind of ground-level network that takes decades and massive amounts of capital to replicate. Add in the fact that their newer consumer segment just turned profitable in FY26, and well, you've got an incredibly robust business model.
Moving on to Part 2. A record-breaking financial engine.
If you thought the market share was impressive, financial year 2026 was an absolute blowout. Revenue surged 29% to hit nearly 29,000 crores. Profit after tax jumped 32% to 2,708 crores. But the most vital metric here, the one you really need to care about, is their free cash flow. It nearly tripled, going from 849 crores to 2,331 crores. This proves their growth isn't just some accounting magic, it's translating directly into cold, hard cash in the bank.
Because of all that massive cash flow generation, Polycab boasts what I like to call a fortress balance sheet. They are sitting on a net cash position of 4,190 crore rupees. And here's the absolute kicker, they have virtually zero debt. We're talking a debt-to-equity ratio of just 0.01x. This gives management insane financial flexibility. They can fund new factories, aggressively expand that consumer business, or weather any economic storm without even breaking a sweat. And they aren't just hoarding this cash either. They are compounding it with exceptional efficiency. They're maintaining a return on capital employed of around 30%. To put that into perspective, that's roughly 2.5 times their cost of capital. In plain English, for every incremental rupee they pump back into the business, they are generating massive economic value for their shareholders.
Okay, Part 3, the Forensic Health Check.
To make sure these numbers are the real deal, the research ran the data through some heavy-duty quantitative models. And it's a completely clean bill of health. They scored a perfect 9 out of 9 on the Piotrowski F-score, meaning profitability, liquidity, and efficiency are all improving. The Altman Z-score sits at a very high 14.33, putting it deep into the safe zone, so bankruptcy risk is practically zero. Plus, the Benish M-score is negative 2.8, which shows absolutely no signs of earnings manipulation. Honestly, it's one of the cleanest forensic profiles you'll see in the large-cap space.
But we have to stay objective here. Part 4, Threats to the Throne. The biggest, most significant long-term risk highlighted in the research is the entry of deep-pocketed conglomerates. Sure, Polycab has a massive incumbent advantage with brand legacy and that locked-in dealer network. But giants like the Adani Group and the Aditya Birla Group are moving into the copper and cable space. These guys have the immense capital required to just bypass traditional barriers to entry. They could easily spark brutal price wars to grab market share from incumbents.
Beyond the looming threat of new competition, there are a few other watch items to keep an eye on. For one, the promoter's shareholding has gradually drifted down from about 69% to 61.5% over the last few years. There's also the constant reality of global copper price volatility, which hits their material costs directly. Also, that EPC business segment we mentioned earlier actually struggled recently, dropping 13% in revenue. Finally, analysts are keeping a very close watch on over 4,200 crores in off-balance sheet acceptances. Which brings us to the real nail-biter. Part 5, the valuation debate.
Right now, investors are caught between two totally contrasting scenarios. The bull case assumes Polycab keeps aggressively climbing to a 35% market share, their consumer electricals hit an 8% profit margin, and earnings just keep compounding at 25%. But the bear case? It warns of those conglomerate-driven price wars and a potential copper squeeze. If that happens, the market could completely reevaluate the stock, dragging that premium 47 times multiple all the way down to a much more average 25 times.
So let's look at what the math actually says. A two-stage discounted cash flow model, which, estimates value based on future cash generation, suggests the intrinsic value of the stock, assuming a 12% cost of capital, is around 6,283 rupees. Since the stock is trading much higher than that, it implies it's currently at a roughly 34% premium to its intrinsic value. So the takeaway? It is an incredibly high-quality company, for sure, but buying at these levels leaves almost zero margin of safety if growth slows down even a little bit.
All right, bringing it all together. Part 6, the final verdict. The verdict arrives straight from the source material is essentially a strategy of patience. The note suggests accumulating the stock on market dips, specifically targeting entries below 7,800 rupees to build a much better risk-to-reward ratio. If you're willing to hold, the base case target over a 2 to 3 year horizon is between 9,500 and 12,000 rupees. It's a classic story, an undeniable quality compounder that simply requires strict valuation discipline before you deploy your capital.
Before we wrap up, a quick but important disclaimer. The analysis shared in this video is for educational and informational purposes only. I am not a CB-registered research analyst or investment advisor.
Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a CBI-registered professional before making any financial decisions.
If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon to never miss an update.
I want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name in the comments below, and it might be the subject of my next video. Thank you for watching, and keep your investing stress-free investing. But I'll leave you with this final thought. Will Polycab's massive moat hold strong against the conglomerate giants, or is this absolutely perfect run about to short circuit?